They say desperate times call for desperate measures. When companies look for leaders to guide them through periods of high economic uncertainty, overconfidence is not typically a trait that would be at the top of their preferred list, especially if you consider that something that has led to some of the biggest corporate failures in history. With COVID-19 being a defining desperate time in the modern business era, it's afforded us the opportunity to test a hypothesis. Is overconfidence of corporate CEOs a trait that is useful during periods of economic crisis? In this study, my collaborator and I look at the stock market performance of US companies in the initial months of the COVID-19 outbreak and found that those with overconfident CEOs actually performed better in the stock markets. Let me explain this in numbers. COVID-19 brought an average hit of around 0.52 percentage points in terms of daily return to companies. We found that the presence of an overconfident CEO at the helm actually helps to mitigate this negative effect by about 37%. So, what did these CEOs do right? Well, for starters, one thing that they do a very good job of is putting a positive spin on things. This was especially useful when the overall market sentiment fell for all firms during the pandemic. Super confident CEOs were able to manage public perception by putting out a positive image of their companies, influencing investors' perception and their willingness to invest in their company's stock in the process. This halo effect was extremely valuable, especially for the typical company that faced high uncertainty and a lack of resources during this period. Another area that these CEOs were good at is withholding bad news, or releasing more slowly while emphasizing the good ones. It's something that others in the market may find questionable, but it's actually quite useful during a crisis. In our study, we found that super confident CEOs did indeed withhold more bad news, and this led to less negative stock price reactions during the pandemic. However, this superpower doesn't work in all circumstances, and certainly not all the time. If a company were already on the verge of bankruptcy, then no rational investor would possibly be fooled by any amount of positive energy that a super confident CEO could conjure up. Overall, we find that the positive impact of overconfident CEOs only works for companies which already had a high level of cash holdings, lower leverage, higher return on assets, and a larger market capitalization before the crisis. Also, we found that this positive impact only lasted during the actual crisis period itself. Once companies started to recover with the help of government intervention, this magic would vanish into thin air. Our advice for companies who are looking for the right person to lead them through the storm is this: think twice before turning down a candidate just because they seem more confident than usual. Keep in mind that this can be a very useful trait in crisis periods. They should also remember that when desperate times come to a close, desperate measures may no longer be appropriate. Would you like to know more about my research? Read the full article on China Business Knowledge at CUHK.